All attendees are in listen-only mode.
Hello everyone, welcome to BYIC webinar. Thank you for coming. My name is Shane. I am the moderator for this webinar. Now to ensure that you can hear us, I want to do the audio check now. So on your screen, there is a webinar control panel. Do you find it? So there's also a button to indicate that you raise hand. So if you can hear me clearly, can you click the raise hand button? Let me see. All right, I see some hands now. There are still some hands not raising yet. On your screen, whether it's on your iPad, on your iPhone, or on your tablet, or on your desktop, there should be a control panel, and there should be a one button to indicate that that you want to raise hand. If you can hear me clearly, can you click the raise hand button? Okay, awesome. You all now can put down your hands. Thank you. Click put down your hand. All right, perfect. Now we are doing this webinar live. So let me turn on my webcam for a little bit. All right. Can you guys see me? Hi. If you can see me, please raise your hand. All right. Okay, awesome. Now, so PC, you want to turn on your webcam for a little while?
Okay, it's already on.
It's already on. Okay, awesome. Now, for smooth delivery of this webinar, we actually can't share the webcam because we want to make sure that the bandwidth is enough. So we would just want to stop sharing the webcam for a little bit. But this is me lah. So I'm Shane.
Yeah, and I'm PC.
Yeah, PC. Can you please? You can turn off your webcam now.
Okay.
Yeah, today we have an amazing turnout of our webinar attendees, and we feel very encouraged. Now, you know, the first step to success is by showing up. As you know, our maximum capacity for this webinar is 100 packs. So I think today we have received a registration of 400 over people. So for those of you who are watching it right now, you are one of the first 100 persons who attended. And I want to congratulate and thank each one of you for showing up to learn about investing. Now, for those of you who can't make it to catch our webinar online, no worries, you'll be sharing a recording shortly. So make sure that next time you log in early to secure our precious seat, okay? Now, our topic today is quite special. It is about the REITs, Real Estate Investment Trust. Now, our speaker today has spent incredible amount of time to research this topic, and he even published a book on REITs. So today you're going to learn about what is a REIT, what are some of the types of REITs, and how do you consider REITs as an alternative to property investment, and how do you evaluate a REIT? What are some criteria for you to invest in income producing REITs? Now the webinar is approximately 90 minutes long, and it consists of two segments. The first segment is 60-minute content by our speaker, and then it followed by a 30 minutes Q&A. But the timing is tentative because sometimes we may have a lot of overwhelming questions that the speaker may want to spend more time to answer the questions. So sometimes we go a little bit overboard in terms of timing for a little bit because there's so much more we want to share with you. Now, to begin this webinar, we want to have a disclaimer. So basically, this tells us that whatever we share today is for educational purpose, and Bursa Malaysia or nor the presenter will be liable for any kind of recommendation that we give to you. So all participants or people reading this webinar or attending this webinar must know that you have to seek independent advice and rules prior to relying or take any action based on the information presented. So all the information or case studies are our presenter's own view. All right. So we have a series of webinars in store for you for this year. Now, today is our first session. Actually, it's our second term running this webinar. Last term, we also received incredible support from all our online viewers. So in 2017, we have at least so far we have identified 10 sessions to do for you. The first session is REITs 101, which is today. Then next Tuesday, we have master financial statements. Then in May, we have mastering financial ratio. In June, we have introduction to candlestick. In July, we have how to invest in growth stock. And in August, we have how to invest in cyclical stock. And then subsequent month, we have how to invest in value stock, how to invest in turnaround stock, how to identify a sunset stock. And we also have how to uncover the myth of oil and gas industry. So this series of webinar is brought to you by Bursa Malaysia and it is managed by us, LifeChamp. So we are a training company dedicated to accelerating your journey to financial success. So without further ado, let me introduce our speaker today. Now our speaker today, he graduated from National University of Singapore in 1989 and he has more than 26 years of working experience with several public listed and multinational companies. And aside from that, he is also an author for Invest in Foreign Shares, which reached popular top 10 non-fiction bestseller in August 2014. And he's also a famous author for Invest in REITs, this book. All right, he's an expert in REITs. And he's a full-time investor, an author and trainer, and have been investing in Bursa and international markets since 1995. Now, our speaker today is PC Wong. All right, so let's see. Hang on, yeah. PC, I will now pass the control to you.
Okay.
All right, hang on, yeah. Let me find you. All right, did you get the screen?
Yes.
Awesome, I see your screen now. Yeah. Take it over.
All right. So I will start now. First of all, thank you for tuning in. Today's topic will be talking about what is a REIT, what are the types of REITs, and REITs as an alternative to property investment, how to evaluate a REIT, and adopting a long-term view in REITs investment. So let's talk about REITs. What is a REIT? REIT or REIT is a real estate investment trust. Now, these are assets which are backed by securities, okay? The assets can be commercial or residential properties, infrastructure, or transportation assets. So in most of the REITs listed in Bursa, you will have most of them are landed properties, okay? But in some other markets, REITs are very diversified, okay? Just to share some with you, not necessarily you have to have a shopping mall, but in England, there's one REIT that actually have shop houses located all over the country, okay? And then there's also ships which are, you know, treated as a REIT, where, you know, the rental rates are actually the freight charge. And also there is a broadband, which is also a REIT, which is based in Taiwan. So you can see that REITs actually have a very, very wide scope. And right now, a lot of it is being focused on commercial properties, residential properties, infrastructure, and transportation assets. Okay, so REITs are also listed via IPOs and traded like any ordinary securities in the stock exchange. Okay, so income primarily is derived from the rental of properties. REITs must distribute at least 90% of their net income to unit holders. That is why it is very attractive for people who want to adopt a very long-term view in terms of investment, because all REITs under the guidelines and regulatory regulations here, they have to distribute at least 90% of their net income to unit holders. And the SC regulation stipulates that a REIT's gearing, which is the total borrowings divided by the total assets, must not exceed 50%. So unlike stocks, which some of you will have some companies that because there's no limit on their gearing, you have companies that keep on borrowing money to grow the business, but then sometimes that amount of borrowing, okay, incur a lot of debt, and therefore the company, if there's any shock in an economic downturn or such, then the company would suddenly find that they are burdened by a huge debt, which with a shrinking revenue. So in that sense, REITs investment actually do offer some security, okay, on your investment, okay, because the company cannot borrow money, okay, to grow, to acquire assets, okay, when it's so that it's gearing, okay, will not exceed 50%. Okay, in that sense, there is some level of security. You will not have a REIT that keeps on borrowing until you know the whole REIT is overburdened with debt. So these are some of the safety feature of investing in REITs. So what are the types of REITs? Now there are several types of REITs in Malaysia. Predominantly, you have the shopping malls, office blocks, warehouses, industrial buildings, hospital and healthcare centers, hotels and resorts. Okay, REITs which consist of several types of asset class are often termed as hybrid REITs. Okay, they have no specific focus. Okay, so REITs which have a specific focus on a single asset class are mostly retail REITs, which are very focused in the shopping malls area sector. Okay, you have office REITs, which are predominantly assets that are office buildings, hotel and hospitality REITs, which are hotels and resort space, and healthcare REITs, which are hospitals and healthcare centers. So let's look at a hybrid REIT. Now it consists of several types of asset class, and the risks are spread across all properties. And this is very, it will have some safety feature to a certain extent, because in a downturn of a specific sector, it may not impact other sectors. For example, if let's say that particular REIT, okay, in this case, Axis is actually a hybrid REIT because they have assets consisting of offices, industrial buildings, warehouses and logistic buildings, manufacturing facilities and hypermarkets. Now, assuming that's a downturn in the retail industry, and to a certain extent, okay, it will impact those retail-based industry, which is the hypermarkets. So rather than, if let's say, you know, rather than just focus into just retail type of REITs where, you know, it's shopping malls, and a downturn in retail industry could actually put pressure, okay, on the rental, okay, you have then that impact is minimized because there are other income streams. For example, if let's say manufacturing facilities, you have that manufacturing facility that's already leased out, okay, machineries moving in. So even if there's a downturn, you would not have suddenly that manufacturer abandoning that property, okay, versus in a retail environment where due to pressure of the economy and poor sales, you may have certain vacancies, okay, because some retailers would have to close their operations, yeah. And just as in warehousing and logistic, okay, these are actually distribution centers, okay, and they are also in demand currently, okay, especially in terms of you know, people need storage, okay. So in that sense, Axis REIT is highly diversified, and there's no specific sector that would be greatly impacted by a weakness in other sectors. Of course, if we look at a global economic slowdown, then of course all REITs would also be affected somewhat. Now the other is office REIT, okay, very focused on office buildings, multi-tenanted structure, okay, but then glut in office buildings may impact upon rental income because quite recently there's a lot of construction projects that involving commercial buildings, offices, shopping malls, and to a certain extent, a glut will actually impact the kind of rental that normally a good office space would be able to command. Okay, so and one example of an office REIT is actually UOA REIT. Most of its rental income is derived from the lease of office spaces, okay, and they also have some small retail exposure, but predominantly is actually very focused in the office environment. Then you have the retail REIT, okay, focus on shopping malls, multi-tenanted as well, but because there's an overbuild of malls vying for tenants, this could impact upon the rental income, as I mentioned earlier. And if let's say during any economic downturn, the first sector that will be very impactful would actually be the retail industry. Because if, let's say, there's an economic downturn, people wouldn't want to spend so much. And this could actually hamper the kind of revenue that the retailers would normally command. Because of a falling revenue, then the shopping mall REIT, okay, which is leasing the spaces to these retailers, could not raise the rental, or the retail the retail players who rents the retail space would demand a lower rental rate. So that's why shopping mall REIT would be very highly susceptible to economic downturn, simply because consumers would be cutting their spending. Okay, one example of a retail REIT would be Hectare REIT. The other one is Hospitality REIT, very focused on hotel and resorts. Income is derived from sale of room nights, seminars, meeting packages, and F&B. Okay, multiple income streams, but room nights are heavily dependent on tourist arrivals and corporate bookings. So one example is actually YTL Hospitality REIT. Okay, but again, if there is a downturn in economy, if the influx of tourists coming in would be somewhat affected, then the entire hotel industry could likewise be facing some pressure. And if, let's say, that particular sector is focused on hotels and resorts, could see, them being under pressure, and would most likely lower the room nights rate. Okay, in which case would put pressure on the income as well. But in any upturn of an industry, okay, for example, in a booming economy, yes, then hospitality REIT, because of a heavy influx of tourists, okay, there'll be a shortage of rooms, and therefore you can actually sell at a much higher rate. In that sense, that REIT would become very, very good yielding, okay, to the investor. But I think in this case, YTL Hospitality REIT has managed to diversify, because their assets is not just only in Malaysia, because they also have one in Japan, and if I'm not wrong, they also have one in Australia. So assuming if the yen, okay, would strengthen versus the ringgit, or the Australia, like the Aussie dollar right now is strengthening against the ringgit, now then that income earned in foreign properties, okay, converted back to ringgit, may see again. So in that sense, that having multiple assets in different countries, okay, help to buffer the kind of pressure, okay, because one country may have a shortfall in influx of tourists, okay, but others may thrive, okay. So there's also healthcare REIT, very focused on medical facilities and hospitals, income derived from rental of these properties, okay. Now, healthcare REIT could be one that is also quite enduring to a certain extent, because there's always demand for healthcare, and in a growing middle income class, okay, the demand for private healthcare would actually increase. So if let's say you are, if let's say the REIT is very focused on healthcare, okay, there will always be people who need that kind of healthcare service, okay, be it in terms of sickness, okay, in terms of medical checkups and all those, okay. Especially Malaysia is also heavily promoting health tourism, okay. And because Malaysia medical fees and such are much cheaper versus our closest neighbor Singapore, and that's why some of the hospitals or healthcare centers in Johor actually do enjoy very, very good patronage, even all the way up to Malacca, okay. So in that sense, that they are more recession proof to a certain extent, okay. So example of an healthcare REIT is the Al Arca Healthcare REIT, okay. It is the only listed healthcare REIT currently. So how do REITs gain in price? Now, REITs assets are hard assets, okay? If once the REIT invests in the hard assets, okay, over time, there will be income from the rental of the hard assets, and also the value of the hard assets would gain. Any increase in the value of hard assets and income distributed to the unit holders would result in an increase in the REIT's unit price, okay? Because if, let's say, the yield continue to rise, okay, people would then see that, hey, this REIT actually offers a yield that is better than the current FD rate by a wide margin. So then, you know, people would want to invest in this REIT. And when there's demand for a particular REIT that gives a high dividend yield, okay, then the price will appreciate. Of course, as the price appreciate, the yield would tend to drop. So that's why you can see that REITs do not rely just on a single asset, okay, and that's it. They would actually, most REIT would try to acquire new assets so that they can actually grow the income base, okay, and that's how REITs will acquire more assets, leading to more assets being able to enjoy rental income. There'll be increase in rental income, and when there's increase in rental income, of course, being 90% that must be distributed back to the unit holders, there will be increase in the distribution income as well, and then this will push the increase in price per unit. Okay, this is how the evolution of a REIT is. Now, the attractiveness of REIT. First and foremost, I think it is the steady income stream, okay, where most REITs currently have yields that are higher than the current FD rate, okay. Appreciation in value over the long term as company accumulate new assets. REITs also have low barrier of entry. Most REITs are reasonably priced. You invest within your means. Now, most of the REITs are actually in the few ringgit, 1 ringgit plus to a few ringgit kind of value, versus some people might say that, hey, you know, BAT may pay a very high dividend, yes, okay, but in terms of the monetary value is huge, but once you do the dividend yield, it may not yield that kind of attractiveness that a REIT will be able to yield, okay. So and furthermore, okay, you can actually it's reasonably priced, and you can actually buy 1,000 units or 2,000 units without, you know, having a higher demand of your own capital exposure, okay. And the other thing is high liquidity, okay. Unlike property, okay, if let's say you buy a property and you decided to sell it, now buying is quite simple, you know, you just sign, and then right now some don't even want a down payment, okay, and but only when you want to sell it, then you actually have quite a lot of hurdles, okay. First and foremost, if you want to sell, you need to unless you advertise in the newspaper yourself or through other social networks, okay, otherwise you engage the service of a real estate agent, and then you have to pay him a commission, and that buyer pays you a 10%, and after that he has 90 days to execute that loan. And once that loan is executed, the property buyer would actually have to the bank that furnished the loan actually would then issue a redemption letter, okay, and then only when everything is all right, okay, once your own loan has been redeemed, okay, you have to wait for the bank maybe another 1 week or 2 weeks before you get your full payment. So, you know, from the sale of it to the final amount that you get, okay, it's quite a long period. But in terms of REIT, you can buy and you can sell and you get paid, okay, within the trading within the next few trading days, okay. So in that sense, it has high liquidity, okay? And you no need to go through the hassle, that you go through when you need to sell a property, okay? Now, opportunity to own a piece of prime real estate and participate in its growth story. Now, a lot of us who invest in the stock market, be it in stocks or REITs, normally most of us are ordinary working class people, okay? Now, for us to buy a piece of a property in the Bangsa area, okay, or in the Mid Valley area, maybe at the current price, maybe quite beyond our means, okay? But then through REITs, okay, you can actually own a piece of prime real estate because you are a unit holder of that prime real estate, which means if let's say that rental in the prime area increases, then it will also impact upon the distribution income that that's distributed back to you, okay? So REITs in that sense, okay, give you exposure to prime areas, which normally, for us who wants to flip property, it's like for investing in property, it seems like we are investing further and further away from the town or city center, okay, because that's where our affordability lies, okay? But putting your money into REITs immediately allows you to have a prime real estate. Now, in any severe economic downturn, prime real estate would actually fall by the smallest percentage because forever they'll be in great demand, okay? Versus if let's say you invest in a property in a quite far away suburban area. Now, for a major recession or something like that, we'll easily see the property price fall 30 to even 40%. But in a prime area, it may even fall around the 20 or less percentage, okay? Because the moment people realize that the market price has dropped, people wants to have a piece of it, okay? So in that sense, people will always want to live, stay, and enjoy the lifestyle in those prime areas. And that is why forever there'll be demand for the rentals, for the shop lots there, or for the office space there, okay? And the other thing is that REITs are highly regulated, thus offering some measure of investment security. As I mentioned, okay, some company, they make a lot of money, okay, by the billions, but then they pay a very, very meager sum of dividend, okay? So where a REIT is concerned, whatever net income that they have after deducting all the various expenses, they must pay at least 90%, in the form of distribution back to the unit holders. And as I mentioned earlier, there's a 50% limit on the gearing. Okay, of course, that 50% limit is a safety measure. Okay, but then it doesn't mean that it is foolproof. Yeah, one of the things that you must realize that where risk is concerned, because that's the cap in the gearing, some REITs, when they acquire assets, okay, they may not be able to borrow a lot of money because of the cap. So what they do, they dilute, okay, the units, which means they have even more units being offered, okay, or sold, and sold as a placement, new placement of new units. Okay, now when that happens, okay, you will see that the price of the REIT will dramatically fall. Now, one of the example is like what happened to YTL REIT quite some time ago. Okay, when they acquired the foreign properties, okay, they actually have to issue a huge placement of new units. Immediately, that caused that price of the unit to fall quite significantly. So, although that gearing is not 100% foolproof, you will also need to study whether that particular REIT, okay, has overextended their abilities, okay, or if you find that that REIT, okay, is on the right track and they are going to issue new placement of units, but you see that potential, then it's also for you to gauge that, hey, it's all right, okay, if the price of the REIT drop, I'll just accumulate more. So it actually depends then your own investment appetite for risk. Okay, so just to tell you, okay, although there are certain caps, especially the 50% gearing, is not 100% foolproof. Okay, some acquisitions can still come through placement of new units, okay, to generate that kind of capital to make an acquisition. Okay, now REITs are very ideal for new investors, retirees, and middle income earners who wants to invest over the long term. That's because if let's say you are a working person, okay, you are employed, and if you are young, one of the things that you want to concentrate is actually on your career, right? You do not want to spend most of your time, even when you are working, looking at the charts, okay, or the technical indicators. Okay, then your boss would be wondering, what are you up to? Okay, so then by investing in REITs, you actually have some peace of mind. If you have select a very, very good REIT, strong financially, you know that that company would not be able to be in financial distress, okay, based on what their financial statements are indicating. Then you can actually have peace of mind. You know that you have an investment that is earning you steady income, okay? It's a financially sound company, okay? You no need to monitor the charts and all, just so that you make a couple of $100 here and there, and then you are not really concentrating on your career, okay, in the long term. Okay, so that's one thing I like about REITs, is that it gives you some peace of mind. You no need to worry over certain cyclical things, because in comparing the impact of economic shock of REITs versus stocks here, REITs normally come within a much narrower band in terms of the movement of the price in an economic shock. Okay, it could move maybe about 20% on an average, okay, drop in price, okay, or maybe slightly more than 20%, but hardly you see a REIT, okay, falling 50, 60 or 70%, unless that particular REIT is very badly managed, which then you shouldn't put your money there, okay, because the financial statements will have come up with various indicators to raise a lot of red flags. Okay, but if you have found a very steady REIT, okay, in terms of economic shock, the price movement would be within a much narrower band than stocks. And if let's say that company is very strong financially, when the price has fallen, it's even better for you to accumulate, because when the economy spikes back up, you will have a tremendous yield. Okay, because if the share price is high and then the income distributed starts to increase, then your yield would be fantastically high. Okay, so that is why that sometimes you need not be afraid of certain down cycle. Okay, as long as the company you have, the particular REIT that you have selected is very strong financially, because that is when they will be very aggressive, accumulating good assets that are on the cheap. So this is a comparison, okay, comparing REIT as an alternative to property investment. Now, first and foremost is that no down payment required. Okay, properties, some may require down payment, some may not. But if let's say you are looking at properties that are in excess of a certain limit here, I think it's more than 500K or near towards the 1 million. The bank would not give you that kind of loan as high as last time, like 90%. Maybe they'll give 70 or 80%, which means you still have to come up with substantial amount of money as a down payment. Okay, then no loan is required. You invest within your means. Now, if you buy a property, you need to finance the purchase, because if you buy in cash, a property that's few hundred thousand to 1 million, lembaga hasil dalam negeri will actually come knocking on your door. Yeah, okay. So in that sense, you need to finance your purchase. So when you finance a purchase, okay, you will start incurring interest. So whereas a REIT, okay, you invest within your means, Okay, as and when you have that capital that is free, okay, you can select the type of REIT that give you the best dividend yield. Okay, then over the long term, you know, you will not be too far off badly. Now, for example, I in my book I actually did a calculation here. Assuming if you buy a REIT that gives you 7% dividend, okay, and once you get that 7% dividend, you reinvest back into a REIT, okay. Now, using the same time frame of a 30-year period, because right now a loan is 30 years, okay. Using the same 30 years time frame that you every 7% you get, you reinvest back into the REIT. Over 30 years period, it will yield you, if I'm not wrong, 600% in terms of returns. Okay, and that's quite huge here. Okay, now if you buy a house, okay, yes, property may appreciate, okay, but then whatever when you sell that property, you still have to minus the kind of outstanding loan. Okay, and after 30 years, okay, the amount of loan that you likely need to, the amount of loan that you finally pay off would be nearing to about 2 to 2.5 times your original purchase. Okay, so in this sense, you know, REITs are actually as long as you have that free capital, okay, you can start investing and build your portfolio. Now that is that 600%, you know, does not come with the price increase. Now, assuming that because there's cycles up and down, that a REIT appreciate maybe about 2 or 2.5%, you know, average out over a year. You know, if we include that kind of 2 or 2.5% appreciation in price of the REIT each year, and we compound it, plus the dividend that you reinvest back into that REIT, your total return over a 30-year period is actually 900%. Okay, close to 10 times. Okay, so that's why REIT is something that you need to have patience to grow your portfolio. You know, it is not something like you hear what people say or rumor and all those, then you you start to trade the momentum. You know, make or break it. You know, that 20, 30 cents, you buy a few thousand, then you make that kind of money. But REIT is a very steady kind of investment. Okay, it would not give you that kind of 100% return in a year or such thing. But then if stability is what you want, so that you have peace of mind in your investment, you no need to monitor the stock movement and all those so frequently, okay, then REIT is very ideal. Okay, now as I mentioned, it's high liquidity, easy to enter and exit your investment. You get paid within days. Okay, now again, you know, long process to complete a purchase, even longer process and duration to exit. Okay, could be many months before you finally get paid the full amount due to you. The other thing is that risk is less risky in terms of financial commitment and in the event of escalating interest rates. More risky in terms of when it comes to property investment, if let's say, okay, in terms of financial commitment in the event of escalating interest rates. Now, most of us that are currently working, okay, those of us who worked during the 1990s all the way to currently may not remember two events that actually saw interest rate escalate to horrifying levels. Now, one was during the hyperinflation of the 1970s. For those who are about my age, you may recall at that time RTM kept on broadcasting about, you know, complot sorrow, you know, jangan membazir tanaman buah-buahan sendiri, you know, all those kind of encouragement on the media, because at that time interest rates were running in the high teens. Okay, which means, you know, mortgage rate could be 15 to 18%. Okay, because at that time the FD rate, if I'm not wrong, was about 12 to 13%. Okay, and that during the period of hyperinflation, it occurred. And if let's say you are buying a property, you know, and there's a case of hyperinflation, okay, then you will suddenly realize that, you know, the rental that's supposed to cover your financial commitment in terms of interest payment may not be enough, okay? So that is when you will be in very, very deep trouble. Now, the other short period where high interest came was during the 98 financial crisis, where interest rate spiked all the way to the teens as well, okay? So history, some people say, will not repeat itself, but often it rhymes, okay, which means there could be a case that is forming. Now, what is happening right now in the global market is that all the major economies are printing a lot of money, okay, the US, the China, EU, and Japan. Global debt currently is already more than 300% of global GDP. So this amount of money printing, okay, would someday create a hyperinflation because money is, you know, it's like printed out of thin air. So it could be a trend that is coming, okay, and may suddenly see a spike in interest rates, okay. So if the US continue to raise interest rate, it will also affect most of the economies where they have to follow. Otherwise, you know, the local currency would see an escalation of conversion into a particular foreign currency. And that is when, you know, it's just like what is happening in China. Everyone is converting to Bitcoin, converting to US dollar, you know, because the Chinese renminbi keep on falling, okay? So that's why if major banks start to increase interest rate, somehow or rather, bank and government may have to follow. Otherwise, you will see an escalation of our local currency being weaker because people are converting more into a particular foreign currency. So that's why you cannot say that hyperinflation will not happen or higher interest rate will never happen, okay? Because everything is very uncertain. It's just that when it comes to whatever investment, whether in stocks, property, or REITs, okay, never extend beyond your means, yeah, okay? Now, the other thing is that REITs allow the average middle income earner to invest in prime real estates as a unit holder, okay? As an average middle income earner, your investment is limited to your level of affordability, and prime real estates could be priced beyond your reach. So on one hand, the REITs will allow you to have a stake in a prime real estate, okay? But if you are investing, okay, for rental purpose or to flip the property, you know, you have to go further away from the prime areas. But that is when demand in those areas would not be as strong as those in the prime areas, yeah? So it's a chicken and egg story. Now, the other thing is that properties are managed by professionals in a REIT, okay? Best rental is assured, okay? You participate as an investor, not as a caretaker of the property. Now, a lot of these REITs, when they lease out, okay, they will always seek the best rental possible, because sometimes these property management companies that manage the REITs, they are rewarded by units of the REITs themselves, okay? So, for example, instead of paying this property company hard cash, okay, they will say that, okay, I will reward you in terms of units, which then you can actually keep and earn dividend, or it's up to them whether they want to sell into the market. So sometimes it's being offered as an incentive. So that's why this bunch of professionals who are the caretaker of the REITs would go for the best deal. But in terms of properties, okay, you manage your own property, including paying the various bills and making good any defects caused by the tenant or due to normal wear and tear. Now imagine, you know, just as when you are busy, you know, you have tenant calling you, you know, hey, I got something wrong, you know, I want you to repair this, you know, as soon as possible, blah, 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 you know. So you don't actually have peace of mind to a certain extent, okay? Whereas in the REIT, you do have peace of mind because you know that it's being managed by professionals. They will look for the best deal possible, okay? Now in REITs, there's no severe fall in revenue if a vacancy occurs, as long as the overall occupancy remains healthy. You look at it in a shopping mall. Most shopping malls, okay, I would term a healthy occupancy in a shopping mall as long as it is above 80%. Okay, if let's say the shopping mall is 50 plus to 60%, it should not be even opening at all. Okay, because once you have that much of vacancy, you will never be able to cover your operating expenses, overheads, and such. Okay, so that's why most of the prime real estates, okay, the occupancy rate is very, very high. So if suddenly one tenant decides to terminate their lease, okay, hey, it's not a major problem, because that let's say tens of thousands rental per month, okay, is a small percentage versus the overall revenue that could be more than 100 million a month. Okay, so in that sense, that vacancy will not directly impact the top line, okay, very severely. But if let's say you are renting out a property, you will not earn anything if your property becomes vacant, as simple as that. Okay, so that's why then in that period where you are finding another tenant, you have to pay the full amount of the interest payment yourself. So the other thing about risk is that the steady income stream, okay, steady income stream is assured, and you no need to, the income is unencumbered, okay. Whereas in the properties, rental income needs to be set off against the monthly loan installment, okay. Now, the only thing is that in terms of capital appreciation, REITs are actually at a very gradual pace when the company increases its asset base and earning capacity. Whereas in property, capital appreciation is subject to market speculation and sentiment. If suddenly all the people rush into that particular property, yes, then you will see that the rental would also spike up. Then you also see that the value of property would spike up. Okay, and then when they flip and they sell, yes, the percentage gain could be higher than a REIT. But then if you look at it, that speculation comes with risk, okay, then you have to compare which actually offers you the lower risk. Okay, now speculation, like currently, market value is different from bank value. Okay, I think some of you all may come across. Okay, for me personally, I have that experience. For example, I have a property in Johor Bahru which I sold at that market price, but the buyer cannot secure the 90% loan for that particular price, because the market price went ahead of the bank's own evaluation. So he has to come up with that kind of difference, okay, in order to buy the property. So that's why sometimes when markets start to get ahead of what the banks are valuing it, okay, it will cause some kind of imbalances, yeah, and that is when certain cracks or certain risks will start to appear. Okay, so events which could impact REITs negatively. It's not that REITs are all good and cozy. Okay, whatever investment you do, there will always be risk. Now, one of it is rise in interest rate, which makes borrowing costly. You can see that a lot of the, as I mentioned, a lot of the REITs actually raise capital through issuing or placement of new units, or they need to borrow to acquire assets, because they cannot retain, unlike a lot of other public listed shares or companies here, they cannot have retained earnings by how many percent, because 90% needs to be distributed in order to qualify as the REIT. And therefore, they cannot have, building up a large war chest of cash, okay? All, 90% at least must be distributed out. So that's why when they want to acquire certain assets, they have to borrow. Now, if let's say interest rate spikes up, the borrowing cost will become costly, okay? And that would make would create some pressure on the financing cost, okay, to the particular REIT. Okay. So now, REITs finance acquisition by borrowing from financial institutions or to the issue of new units, okay, both have negative impact. Increase in gearing ratio through debt, okay. If you borrow more money okay, your gearing ratio would spike up. New units would cause dilution and impact upon the unit price. So this is a double whammy, okay? Change in government policy, which could be detrimental to REITs unit holders. Okay, for example, right now there's a 10% withholding tax. Assuming, you know, that 10% withholding tax is increased to 15, okay, then that kind of change in government policy could actually impact, because suddenly, you know, you see that your distribution income is earning 5% less, okay, but currently everything seems pretty stable, okay, there's no adverse change in policy, so let's most likely that trend would hold for quite some time, okay. And one of the key things is that overbuilt in commercial properties. Now, according to a news article by Chris Prasad dated Wednesday, September 21, 2016, under the title "Dark Clouds Linger Over Commercial Subsector." Now, this is what he says: there is now a mismatch, sizable mismatch between the demand and incoming supply of retail and office space. Describing the condition as critical, Bank Negara Malaysia warned that the oversupply is aggravating an already volatile property market. So as I mentioned, okay, if commercial space, you know, are cropping up everywhere, now they cannot stay empty. So what do the property managers do? They always want to undercut to at least get the tenants in. Otherwise, we have this building that is empty. We might as well, you know, we are kissing all our investment goodbye. So that's why when there are too many commercial properties, the worst thing that can happen is they start undercutting so that they drive tenants to their buildings. Okay, and when this happens, then you actually create a snowballing effect, okay, and depress the market further. So how do you evaluate a REIT? Now, I actually use a method called the KPI method. Now, you imagine that if you are working with a company, okay, how does the company evaluate you? When it comes to your annual appraisal, you know, your boss will actually say, hey, you didn't meet your KPI. Hey, you didn't, you know, you didn't achieve this or didn't achieve that. So right now, okay, you are investing your money in a company. You are the boss of your money. Shouldn't you create a KPI for the company as well? So a lot of people, if you rely on information passed by analysts, okay, then only you buy into a certain REIT or a certain stock, okay. Do you really know the financial strength or the financial potential of that particular company? So since the money is supposed to work for you, okay, and that company is supposed to be working for you, don't you think it's important for you to set a KPI for that company? Hey, you can buy back if your company is public listed, you can buy back your own company and then you become the boss. Okay, so but this is just the whole thing, you know. It's very important for you to have certain gauge to ensure that the company that you invested in is working for you. Okay, and that is why it's important to set KPIs. Okay, so for me, I use a KPI method because a KPI allows me to evaluate a company on a quantity basis. Okay, so KPI in this sense, you know, I will have a scorecard which I'm going to share with you, and in that sense, that is a quantitative method of assessment. The qualitative of the assessment comes from reading what the management plans they have in store, what kind of assets they have acquired, how will this asset contribute to the future of the company growth. Now, all these are very subjective and qualitative. Okay, so that's why to set up that scorecard, I would apply certain KPIs that that company must meet. Now, we all know that the economy right now, you know, is really not very good, not only in Malaysia, but globally. So that's why the higher the revenue growth, I would not set it too high, because if once I set my KPI, it must be realistic based on the current economic conditions. Okay, it must not, okay, be too overly enthusiastic, nor too self-defeating, in the sense that, okay, you set the KPI that is either too high to accept, okay, and then, or you set it too low that it becomes a risk, okay. So in that sense, revenue growth, my KPI is 5%, net profit growth, including valuation gains, is 10%, net profit growth, excluding valuation gains, is also 10%. Now, this is a very interesting thing. When it comes to REITs, you have one thing you must be very careful. Don't just look at the net profit after tax. Wow, you know, there's a 100% gain in the net profit. Okay, the net profit growth was 100%, because before reaching to the net profit, okay, somewhere between there they will actually have net gain in property valuations. Now, that net gain in property valuation is quite meaningless. Why? Because that property is not sold. If that property is not sold, how can they distribute the income back to you? So that's why in assessing a REIT, okay, you must have these two things. One is including valuation gains, and one is excluding valuation gains. If including valuation gains give you more than 10%, don't be too happy first, because if you exclude it, it may be less than 10%, and therefore it would have failed that KPI standard. Okay, so that's why when it comes to evaluating a REIT, you have to take these two into consideration. Now, the other thing is that current ratio, which is the current assets divided by current liabilities. It must be able to be more than 1. Why? Now, current assets are those that can be convertible to cash and all those, okay, easily. Whereas current liabilities are those that the company must pay within a 1-year period. So that is why it must always be more. Now, what happens when it is less? If, let's say, the current ratio is less, hey, the company don't have enough money to pay, you know, in the coming in this coming 12-month period. What are we going to do? Simple. Either place more units, dilute, or borrow money, increase gearing. So that is why, if the company, you will tell how good a company is managed by looking at the current ratio, okay, to determine whether that company, you know, is on the right track. Now, sometimes the current ratio may be less than 1, okay, but that company can still be considered financially sound, and that is why we need to look at the gearing ratio. Now, if let's say the gearing ratio, because the limit is 50%, here is 0.5, okay. Now, if let's say the gearing ratio is 0.2, but then the current ratio is less than 1, then it's quite all right, because at 0.2, it is very far away from the cap of 50%, which means if your gearing is 20%, okay, and you have 50%, you can actually borrow money some more and still not exceed the cap. And that is, you know, then in that case, it makes sense, okay, that certain times the company borrow money, certain huge amount may become due, okay, in the coming 12-month period, okay, and that is when the company may need to borrow money, okay, to pay off that portion of the debt that is due, okay, but they may not put them in critical condition, because if they have a low gearing, then it makes sense, yeah. Now, the other thing is that operating cash flow is very important when you're investing in a particular company. The operating cash flow, okay, ideally should be positive, okay, and then the dividend yield must be more than 5.5%. Now, this 5.5% is not plucked out of thin air, okay, there's a rationale behind it. Now, the current FD rate hovers around the 3%. So at 5.5%, okay, it gives you a clear gap, quite a wide gap between the FD rate and the 5.5 minimum, okay, because some REITs may actually be more than 5.5, and therefore, okay, it exceeds that KPI. Now, in an economic downturn, sometimes the dividend could easily fall 20%. You remember I told you earlier that a particular REIT may see its price move, okay, around 20 to 20+% in a economic, if there's an economic shock. Now, assuming it's that an economic shock, assuming the dividend fell 20%, falling 20%, okay, your yield will still be 4.4%. But in any economic shock, what Bank Negara often do is lower interest. You remember during the last financial crisis, okay, the base rate was around 2.5, 2 to 2.5 actually. You know, that puts the FD, okay, around the 2% region. So even if it's fall to, you know, that's a 20% fall in the dividend to 4.4, and if let's say the interest, the FD rate falls to 2%, you are still, that gap is still maintained. Okay, so that's the reason you need to get it to be or close to this amount. If let's say you buy a REIT, okay, that is quite highly priced and currently gives you a yield about 3.4. Now, if that's 3.5, assuming there's an economic shock, and 3.5%, if the yield fall by 20%, okay, that's 0.7%, okay, your yield from 3.5 now becomes 2.8. Okay, so when you have that kind of yield that falls from 3.5 to less 0.7 to 2.8, then the gap to the FD is very narrow. So that's why, you know,
PC, are you losing connection to the audio? Can you guys still hear us? Okay, I see some of you are saying that no sound now. Just give a speaker a minute.
can you hear me?
Right, you're back.
Okay, I just
Right.
unplug and plug in again.
Okay, yeah.
So,
PC, just want to remind you, you are it's 9:34 now.
okay,
Yes, 1 hour
so,
have passed. You gotta hurry.
okay, so the other is the price to book value, okay, which I put it ideally will be less than 3. So this is the exit rate full year 2016. Okay, you have revenue of 167, okay, to versus 163 million. Okay, net profit with valuation, okay, property valuation is 122 million versus 96 million. Without property valuation gain is 92 million versus 90 million. So you can see that the gap immediately falls to very narrowly. Current assets is like 43 million. Non-current assets is 2.2 billion. Total assets is 2.2 billion. Okay. So current liabilities 377 million. Non-current liabilities 174. Total borrowings of 780 million. Total liabilities of 851 million. Total equity of 1.4 billion. Operating cash flow of 186 million. Total dividend of 8.25 cents. Yeah.
PC, would you want to make your slide in presentation mode?
Yeah, sorry. Yeah.
All right.
Okay. So when we look at the KPI, revenue growth is just slightly 2.2%. I put it in red because it falls below the 5% KPI. Net profit growth with valuation gains is 26, but without valuation gains is just only 1.8. So you see the difference, that one is with, the other is without. Current ratio is very low. Okay, it's very far below the 1.00. It's only 0.11. However, gearing ratio is 0.35, and as I mentioned, they can actually borrow to pay off the current ratio, the borrowings due in the current liabilities. Yeah, operating cash flow is positive. Dividend yield, okay, is 5.1%. Book value 1.27. Price to book value at 1.28. So this is IGB REIT. Okay, revenue of 500 million versus 487. There's a growth here. Net profit with valuation gains 277. Without property valuation gain is still 2.7. So it means that IGB REIT did not do any valuation of the property. Okay, and therefore it remained within that amount. Okay, so you can see that it's actually it didn't fall short like what happened to exit rate. Now the current asset is 293 million. Non-current asset is 4.9 billion. Total asset is 5.1 billion. Current liabilities 248 million. Non-current liabilities 1.2 billion. Total borrowings is 1.2 billion. Total liabilities is 1.5 billion. Total equity is 3.6 billion. Operating cash flow is 357, and total dividend yield is 9.06 cents. So you see revenue growth, okay, although fall short below the 5%, but was higher versus exit rate at 3.7%. Net profit growth, growth below 10%, but close. It was 9.4%. Okay, the same bit or without property valuation. Current ratio is good at 1.14. Gearing ratio also good at 0.24. Okay, operating cash flow is positive. Dividend yield, okay, just meet. So I didn't put it in green because I didn't exceed. Okay, book value is 1.05. Price to book is 1.57. Now this is the scorecard. Okay, where I will compare two REITs. Okay, in order to derive which one is a better choice. Okay, if we base it on this, what's the score? Exit rate at 4 yes and 4 no. IGB also the same, 4 yes and 4 no. Looks like a tie, but actually it's not. And this is when you apply analysis. Okay, based on the scorecard, it may look like a tie, but IGB REIT is actually in a better financial position. Why? Because net profit growth was better than exit rate if we take up the valuation gains. Higher valuation gains give exit rate a bit versus the KPI, but valuation gains are non-distributable. Okay, so in that sense, okay, that's, you know, sometimes when you have that gain in property value, okay, it looks good on the overall income statement, but it cannot be distributed because they have not sold the property. So therefore, to me, okay, personally, I feel that it's a non-event. Okay, it does look good on the income statement, but since it cannot be distributed because it is not sold, let's take it out. So if we take out the valuation gains, exit rate will have 3 yes and 4 no, whereas IGB would have 4 yes and 3 no. Okay, so you see that the balance now has changed to IGB REIT's favor. Now, on top of that, IGB was closer to the KPIs in net profit growth and dividend yield compared to exit rate. Okay, exit rate current ratio is low, indicate that it may need to refinance its debt, and this could further deteriorate its gearing ratio. Now, on the strength of the balance sheet, IGB REIT is stronger than exit rate. So this one would reinforce IGB REIT as a better pick. Now, adopting a long-term view on REIT investment. So I'm using an example as an exit rate. Okay, exit rate during the start was pretty good, but I think a lot of capital was used very heavily as they expanded on multitude of assets, and that actually impact upon their financial. Okay, but assuming that you have bought exit rate, okay, in the beginning of January at 1 ringgit and 88 cents, total dividend paid okay, in all the years, okay, is till 2016 is 1 ringgit and 54 cents. Now, of course, I put it in January. This is just to illustrate only here. I didn't include that if you have bought in January, of course, year 2007, you would have the Q4 dividend yield being added in. But let's ignore that. Just treat it as per year basis, okay? So that this is for illustration purpose, okay? So if you base it on the closing price of 1 ringgit and 63, this one was quite about a week or two ago, okay? After split, okay, because they have a split that 1 becomes 2, okay? The adjusted price is actually 3 ringgit and 26 cents pre-split. Now, your total returns will be then 3.26 divided by your purchase price, which is 1.88, give you a return of 1.38. Now, when you add in, okay, the dividend paid, which is 1 ringgit and 54 cents, is actually 2 ringgit and 92 cents. Now, that 2 ringgit and 92 cents, okay, when you divide it by your initial capital outlay, okay, give you a 155.5% over 9 years, okay. So you can see that based on what I told you just now, that if you have 30-year period, you know, it's close to about 600% and all those. But of course, that one was based on 7%. But for the Axis, only previously their dividend yield was very high, but only recently that it fell slightly short of. Okay, still it's not too bad. Okay, it gives you a 17.3% annual annual gain, okay, over a period of 9 years. So you can see that in this kind of REIT investment, okay, it gives you, as long as you adopt a very long-term view, okay, then you will be able to enjoy that kind of gain. Now, this is what I say that you bought in 2008, somewhere around here. Can you imagine if Axis REIT, you know, during the period of, let's say around 2009, okay, it drops to very low here, 2009. Yeah, it still paid quite a good dividend, you know. 2009 dividend annually was higher than 2008, okay. So if you have bought over here, your dividend yield would have actually increased by a huge amount, okay. This one is, the whole chart is adjusted after split, but based on 50 cents here, it's actually 1 ringgit. Now, can you imagine your yield, okay, giving 15 cents, 15.8 cents over a price of 1 ringgit? Now, that by itself is 15.8% already in terms of yield. So, if you have a company which, a REIT, which you take advantage of because of its financial strength, and there are certain downtime that certain downtrend that you are able to take advantage of, your yield will actually increase tremendously, you know. Okay, especially during this period. Okay, you can see that 2010, okay, was higher than 2009, 2011 higher than 2012, higher than 2010, and 2012 was higher than 2011. Can you imagine that what you bought in 2009 at 1 ringgit, and then by 2012 it gives you a dividend of 18.6%. Whatever you have bought then, the dividend yield has suddenly skyrocketed to 18.6%. So that is why, you know, when you invest in a REIT, you don't need to monitor the charts, you don't need to look at those you know, the kind of movement of the stock, you know, look at it every day to see when you can exit and all those. No, REIT is not for it. You will not see those high capital gains within a very short time. Okay, rather over a longer period, you know, if it can give you 17.3% annually, and versus the FD rate, which is at, you know, around 3% currently, isn't that a very good investment? Okay, so importance of REIT in a portfolio. Now, REITs will continue to nurture and enhance the properties to deliver income growth to the investor and to acquire assets to boost the portfolio. Okay, as a REIT, if they just rely on a single piece of property, then that REIT is not for you to invest at, or you should stay away from this kind of REIT. Only REITs which can nurture and enhance the properties, which means even if they have the same property, but they can nurture it by having rental income gaining. Okay, now one example is actually IGB REIT. Yeah, IGB REIT is very focused on the Mid-Valley shopping mall. Okay, and the way they play with the tenants, the way that they make use of the spaces during the peak shopping periods and so on, they have been able to enhance. Now, this is what we want to see in a REIT. Okay, so it's very important for that REIT to continue to nurture the existing and enhance the properties, okay, and then to acquire assets to deliver further boost to the portfolio. Increase in assets will deliver capital appreciation while boosting your yield over time. It helps to balance your portfolio with steady income streams in periods of uncertainty. And right now, the global economy has never been so uncertain, because, as I mentioned, the whole world is mired in a high debt. Global GDP, global debt to GDP is about 330%, if I'm not wrong. Okay, Japan's debt to GDP is total debt to GDP is about 500%. Okay, US is 300%. China is almost 300% as well. So all these big trading nations, they have so much debt and all those, so it will affect smaller nations, okay, like ours. Okay, because if they all of us list together, we not only have flu, we have high fever also. Okay, so that's why in periods of uncertainty, it's best you have something that you can rely on to grant you steady income stream. Why? Because if the stock market have certain correction, REITs will continue to give you income as long as because they have to distribute 90%. They wouldn't say that economic times are bad, therefore we are not going to distribute. They can't do that. Okay, and whereas certain public listed companies, they will say that economy is bad, therefore we are not distributing any income. Now, can you imagine that if the economy is not doing too well, but then you still have steady income coming in? Now, if the economy is not doing too well, wouldn't the other stock price will actually depreciate? Now, so you have something that gives you income even though that the economy, that additional income allows you to pick up stocks on the cheap as well. Do you understand what I mean? Yeah. So this is the way why it's important to have steady income streams in your portfolio, and not that everything is based on must be high cap, or it must have high potential growth and so on. Just when you needed it, how you wish that you have some steady income stream coming in, and that is when REIT plays the most important role in your portfolio. Because when the economy is not doing too well, you wouldn't want to come up with your own money to buy, but then the REITs give you that money for you to reinvest. Okay, so that's another thing, is that it has lower volatility versus stocks, and therefore it is the ideal defensive play. Now, having said all this, I wish to also disclose that I do not own IGB or Axis REIT myself. Yeah. Okay, this is a case study which I brought forward to share with you, how you can evaluate by assessing one against the other. Okay, so then you will know that if you have done that assessment, at least to your best understanding, the risk profile has reduced. Any investment comes with risk, and the most important thing for you is to reduce your risk exposure first before you think about making huge gain from the stock movement and all those. Okay, because if you fail in your risk assessment, any big shocks come in and you can see a big portion of your capital being wiped off. Okay, so that's all I have for today. Questions and answer session.
All right, awesome. Thank you, PC. Now we are opening up for question and answer. If you have any question you want to ask PC about REITs, you may write it down now and post it there, and then I'll read the questions to PC afterwards. Now, in the meantime, while you are typing your questions, I would like to launch a poll. All right. All right, please refer to your screen. Which of the REITs are you more interested in? All right, select one of the following while you type your question. PC, I'm taking over as the presenter now.
Sure, sure.
All right, we have 70% voted. Okay, give 5 more seconds before we close the poll. Okay, we have now closed the polls. Do you see the result that I share now? I've seen that there are 58% of you very interested in hybrid REITs, 19% interested in investing in office REITs, 38% interested in investing in retail REITs, 27% in hospitality REITs, and 32% in healthcare REITs. So apparently some of you voted more than one. But anyway, it is interesting to see that more than half of you are interested in investing in hybrid REITs. Can you guys see the result on the screen? Right, if yes, could you please raise your hand? All right, awesome. Okay, let me hide the result now. So now, I would like to show my screen. All right, so now we have got some questions here. So while we have a lot of questions, some of you ask more than one questions. All right, but because of time limitation, not all questions will be answered. So for those of you who ask a lot of questions, I will selectively pick a few questions that are relevant. So first question is, in your opinion, if compared REITs to mutual fund, which one would be better for beginner? PC?
I think mutual funds is something that you leave it to others to invest for you. Okay, but for me, I always believe that, you know, if you are able to master your own skill in investment, then you no need to rely on others. Why? First and foremost, you no need to pay a 5% management fee. Okay, that is something which you save. And furthermore, when it comes to unit trust, when certain most unit trusts are based on a selective allocation of different stocks. If 30% of it perform badly, okay, but the other 30% perform very badly, 20% was average, and then the other 50% was okay, acceptable with slight growth. You find that if you sell it, you will not make any money. But if you are able to master your own thing, the moment that something doesn't perform, you can just sell it and that's it. Okay. Rather than you rely on others. That's why we have BYIC to teach you all to master the skills of investing. Not that unit trusts are bad. Okay, but then first thing you save is actually the 5% management fee. I hope that answered the question.
All right, excellent. So we keep your answer short and concise, so that we have more time to answer other questions. Next question is, why is price to book ratio important in selecting REITs? Any attractive REITs to consider in current market? So there are two questions. Over to you.
I think current market, from what what I presented here, I actually looked through a few REITs, and Axis and IGB were among the closest. I think that that give grounds to argue either in favor of Axis or in favor of IGB, because the rest, some of them are very good REITs, okay, but then their price are quite high, okay. Like Pavilion is actually quite a good one, but then the yield is very low. It doesn't meet that kind of criteria. Okay, so if you are interested, okay, you can check several of those REITs, okay, and reassess again, okay, because most importantly, what I presented is based on my risk appetite. Your risk appetite may be different from mine, and therefore, it's up to you to do your homework, assess against a few to see which one will best suit your risk appetite.
Okay, do you answer the why is price to book ratio important?
Okay, price to book ratio, I use it as a guide because no one is going to pay, if let's say the asset, okay, is worth 1 ringgit and 50 cents. Would you pay 3 times the value, let's say 4 ringgit and 50 cents to own that asset? Unlikely, okay? So that's why, that is something like a guide for you to know that, hey, if it's so highly valued already, means that the potential for it to increase in price will be lesser. So that's why I use that as a guide. If let's say the price to book ratio is still very low, around the 1+ region, that's the chance that you will see further appreciation, okay? Otherwise, if already so expensive, the price appreciation would be very limited. So I use that as a guide.
I see. So the next question is, what is the PE value in REIT sector?
I think the one of the things that I don't really look very deeply into PE ratio, there's a few reasons. One is that the earnings, okay, sometimes can be diluted, okay. For example, when you have more units, okay, the earnings may look diluted. But then, hey, but if let's say the net profit growth, okay, is still very strong, okay, then I would look at the potential of that profit more than that price to earning ratio. You know what I mean? Okay, because like a lot of the sometimes the earnings could be well, in REITs it may not happen, but let's say this is based on the discipline that I've also invested in other stocks here. Now, if let's say the company buy back its own shares, okay, the profit may sound bad, but then because it buys back your own shares, the earning per share suddenly skyrocket up, and therefore the price to earning ratio gives you the false belief that it is very low, and therefore it's an acceptable mean, okay, for you to consider. So that's why I don't look at price to earnings ratio that much, because it's based on my discipline that I've done a lot of research, and I've gone through a lot of companies' earnings, and it becomes not true sense in a way, because profit could be low, but earnings could be higher, per share could be higher if let's say the company buy back a lot of its shares. Yeah.
So you feel that price to book value is a more practical way of assessing whether this is overvalued or undervalued for a certain kind of asset class?
Yeah, to a certain extent, because I must tell myself that I'm not going to pay that kind of price. If let's say that, let's say I put it as 3, my own risk assessment is 3. You can also put a stricter assessment and put it 2.5, so that anything that is closer to 2.5 you would not want to invest, because it doesn't meet your expectation of further gain in the price. So like I said, the KPI is something that is based on your own risk assessment. You can change from what I put there, okay, but mine is based on after so many years of experience, that most of the stocks that I invest in hovers around that to be able to give me that kind of yield or give me that kind of return in capital over a longer term period. Now, I'm not a trader myself, okay, I'm a fundamentalist. I look at long-term growth, and some stocks I do hold for quite a long period as well. Okay,
understand. So the next question is, what is the current outlook on REITs? Is it cheap, expensive to enter right now, as most of the REITs had a downtrend revenue gain and reduced in dividend paid last year? Any recommendations? Thanks.
I think a lot of the reason why the REITs actually there's a number of reasons why people dump REITs, okay, and also why the dividend actually for some of the REITs actually reduced. First and foremost was the fear of a raise in interest rate. Now, as I mentioned, whatever especially the US, if Federal Reserve say we are looking at hiking rates, suddenly everyone feels that, hey, if as I mentioned just now, any increase in borrowing costs will actually result in lesser distributable income. So that is why, because of that fear, people dump REITs. Okay. So the other thing is that because, as I mentioned, the shopping mall environment, okay, especially commercial buildings, in that report, as I mentioned, Ben Nagra is already voicing concern because there's overbuilding of commercial properties, and therefore this will actually, people are fighting for yields, various REITs are fighting for tenants right now, to give incentives for them to come. Any incentives that you give for tenants to move into your mall would likely result in a lower rental income. So that's why when there's an overbuild, okay, you will always have that fear. But my rule of thumb is, again, okay, not that I'm promoting IGB, but then if you are interested in a REIT asset, one thing you need to do, whenever you go to that particular place, okay, you cannot find any car park, then that means that the traffic is there, the people are there, and that is the likelihood that that particular REIT, okay, will not see its dividend yield drop too much. Okay, that's why you see that IGB REIT actually has been increasing its dividend. Now, last year during the Bursa Marketplace, okay, event in January, I also hosted a talk on, Bursa Marketplace Fair. I was one of the speaker on the topic of REITs as well. One of the participants asked me, what REIT do you suggest to buy? I said buy IGB. At that time was RM1.31. Okay, so at that time the dividend was even lower than the previous year. Okay, so if you look at it, that right now, I think just in this slide presentation, when I was checking, IGB was RM1.60 something. So why the share price, why the price of IGB REIT actually increased? Because that's how they make use of the place. Okay, there's a lot of traffic there and so on. So if let's say certain shopping malls may have places in Malacca, Sungai Petani, like Hector REIT, okay, may feel some pressure because there is not huge traffic in one single destination. Okay, when you have a lot of malls, you need equally high traffic in all the various destinations. So that's why IGB has been able to do well, okay, by just focusing on what they do best, which is at the Mid-Valley Mall. Okay.
All right, thank you. So that's quite a very sensible rule of thumb. Look at the parking. So next question is, what is the process of buying a REIT?
I think it's the same process of buying a REIT. They are listed on the stock exchange, okay, in Bursa. All you need to do is just do your assessment, find out the REIT that you want. You check against the Bursa listing, okay, of that under the alphabet order, okay. Then you get the code, you just buy, okay.
Okay, yeah. So it's not as usual like how you buy stocks. So next question is, any comments on MQ REITs with properties in areas like KL Central?
I think last year also one of the REIT that I proposed worthwhile considering was MQ REIT, but for this purpose I didn't did the latest research. But back then I was saying that MQ REIT was one of the better buys because its profit was actually in the triple digit because Central keeps on building, and traffic to that area have also increased. So if let's say you're interested in MQ REIT, then I would suggest you stack MQ REIT against IGB, based on the kind of KPI, and then you see who will actually meet the most of the criteria. If let's say MQ REIT meets the criteria, there are more yes for MQ REIT versus IGB, then you might want to consider MQ REIT. Yeah.
All right. So the next question is, the risk associated with REITs, does it mean that we depreciate our money over time if we didn't choose the correct ones?
I think well, you have to look at it a few things here. Okay, this is actually a very interesting question, quite a good one.
Very interesting.
Because sometimes, now, whatever dividend yield that you get, okay, if the dividend yield falls short of the inflation, then, you know, your purchasing power of the same ringgit value would tend to depreciate. Okay, that's why when you select, okay, it's just like in an FD. Why banks give you an FD at a certain percentage? Because that percentage is not a gain to you, you know, it's how much your money will lose value annually. Okay, you know what I mean? So if like the bank give you 2% dividend, it doesn't mean that your purchasing power has gained 2%. It means your purchasing power actually reduced by 2% every year. Why? Because the consumer price index is actually more than 2%. Okay, so in whatever the bank's interest give you is not a gain, because it's just like a hedge against the inflation only. And if inflation spike more than that 2%, you are actually having a lower purchasing power over the long term. Okay, so that's why when you select a particular REIT, okay, understand why the 5.5 and above is important, because Malaysia CPI, you know, hovers around the official, okay, around the 2 to 3% kind of bandwidth. So it's very important for you when you select a particular dividend yield, it must give you higher, okay, than the inflation, the CPI. Then you will realize that you will not have a depreciating purchasing power in the long term, but actually you gain.
All right, thank you, PC. Now, if you are still writing questions, please, we don't have any more time for any new questions. So, but we still have a list of questions here. So now we actually went a little bit over 7 minutes to this webinar. So if you still want to learn more, you can stay on. There are still a number of questions remaining, which are a good one. So next question is there any REITs focusing on the F&B sector, or focusing on the restaurants, dining, etc.? Is it important to have an important backer, Petronas for KLCC, or Johor Corp for a la carte and Al Salam? Right, the question ends.
I think the most important is that well, having a huge sponsor, okay, behind with strong financial resources is important, okay, to a certain extent, because you may have a strong sponsor, but if the management team fails at their proposed agenda, okay, then, you know, it doesn't matter even you have a strong sponsor or not. Well, maybe the strong sponsor will be able to bail out that REIT again. Okay, you know what I mean? So that's why sometimes, you know, do not look at who is behind, but who are the capable people running it right now. Okay.
Okay, awesome. Next question is, would you suggest what kind of REIT for youngster?
I think if you are young and it is one of your first few investment, you can look at one that is very strong financially, okay, and would be able to help you ride through some tough time. Okay, it could be a hybrid REIT, okay, or a strong financial REIT that is, you know, that will not likely see any stress on its financial statement. And that's why, again, whatever REIT you choose, okay, right here we have two examples of Axis and IGB. Then it's up to you to find a REIT and stack it against the both of them. Because I checked through a few and I selected these two because first, it gives a very interesting comparison, and secondly, IGB does, I mean, Axis does have a very strong history, a very rich history in their management of the asset, which is very favorable. So if you have to find one REIT that is able to stack against them and win, then likelihood that REIT will be even stronger financially than both of these, or the yield or the yield could be better than any of these two. Okay, so you have to do that assessment. Okay.
All right.
Because
so,
yeah.
Oh, sorry. Go on.
Yeah, it's okay. Never mind. It's
okay.
Right.
Sorry, I thought you finished answering.
Next question.
So next question is: some REITs have high trustee and managers fee. What is your comment?
Okay. Always look at do not look at the high trustee and all those first on one hand, yeah, because as I mentioned, some of the management team are paid not in terms of cash, okay, but in lieu of cash. For example, in terms of units. So if let's say, and these are sometimes based on percentage, okay, of the total revenue or total profit achieved, okay. So do not look into the high trustee fee as something that, you know, if they are high, okay, means we are overpaying. But if let's say if the fees paid are high, but then the revenue is fantastic, then you shouldn't complain, because you have a team that deserve it, because they are able to give you that kind of return. But if let's say the fees, okay, is very high, management fee and all this admin fee is very high, but then the revenue has nothing to shout about, then I would say, first, you know, this is the major red flag already, which means they are self-serving purpose and they are not looking at, you know, helping the unit holder to gain in terms of value and dividend. Okay.
Okay, nice answer. Next question is, how does the trend in REITs and stocks related? Do both of them reflect the current economy trend?
I think the if let's say it could be sector influence, like currently, because there's an overbuild of commercial buildings, and that's why REITs are under pressure. But then the other economic sectors may not, okay, have that kind of impact. Okay, but if let's say it is a global economy crisis like the 2008 financial crisis, okay, then you will likely see that across sectors it will be impacted, but stocks will be impacted the worst, because, you know, stocks in a worst case scenario, they are not going to give you any dividend if let's say the whole economy tanks, okay, or they give you very marginal dividend, but at least REITs will give you 90% of that, you know. So that is why, you know, in economic downturn, the ratio or the percentage of correction in REITs are less severe versus certain stocks, especially high growth stocks in a economic crisis. You can see them falling, you know, 50-60%. Some even eventually go into PN 14, okay, because they're over leveraged. So that is why REITs is, you know, at least provide some stability. Okay.
All right. So next question is, are newly listed REITs which have been offered in lower price, let's say KIP REITs, potential REITs to invest in? Other prime REITs like Pavilion and Sunway are too expensive to invest.
Okay. Now always look back at the yield. Okay. If let's say it's newly listed, okay, you again look at the assets. If let's say they are just newly listed, yeah, you can look back at their prospectus. Okay, what kind of income growth are they, you know, what kind of net profit did they achieve, okay, based on the prospectus. But of course, prospectus may not be the real thing. So the second step that you need to look is to look at the location of their assets. Are their assets, okay, in very in the city, which at least offer good traffic, okay, or is it going to be or is it going to be some far off places all over town or all over major towns in other states and all those? So, you know, if let's say currently, I would say that, you know, if there's any uncertainty, go for one that has already been demonstrated. Then you can wait for their first quarterly report, and then you assess. Hey, you know, they actually their first real quarterly report announced on Bursa. Okay, hey, they are actually quite good. Then only you take the plunge. Okay, but if let's say, you know, you can rely only on the prospectus. Next, you look at the asset. Okay, where are they located?
Okay.
Okay.
So last two questions. So how do we define proper KPI? Is there any guideline available in the market? As we know, every investor have different risk acceptable level and investment objective.
Yes, I think for me, I said this because it's based on my own years of research and analysis. Yeah. Okay. Like I say, you can follow mine, okay? Or if you want to have a better safety level, you can make it stricter than mine, okay? For example, if let's say I put current ratio must be more than 1, you can put it must be more than 1.2, okay? So that you build up your safety buffer before you accept it, okay? Because if let's say you want to be a greater risk taker, then you say, okay, I can accept 0.8. You know, eventually it's up to you. But mine is actually a guideline based on my years of experience, yeah. And by using this guideline, I've actually made some good returns from my investment. Okay, so this guideline, you know, you can put it as the border. Whether you want to move 10% from it, okay, in favor of, or 10% against it, okay, it's entirely up to you. But that is based on my experience, as I say, okay. You may want to set your own, okay, and it may be different from mine. Because the most important thing is, you must, once you set it, you are already telling yourself, I am accepting that level of risk. So it's your commitment to that risk that you're willing to accept, okay.
All right, so final question. When is the right timing to enter REITs market? As you mentioned, we should collect more REITs when economy is on downturn. Based on the technical analysis assumption, economy may face recession after 10 years. So is it possible for this assumption to happen? Yeah, long question.
I think if you want to understand where is it moving, okay, you just need to look at what's happening in the world, okay. Now, like right now, okay, there are some disturbing trend, okay, like Maersk, the world's largest container shipping company, okay, has its first loss since Second World War. Now, if the world's largest container shipping company is having its first loss since Second World War, okay, it means that global economy is really not doing very well, because shipment of goods is the movement of products, okay, and money. So, but then let's look at it. If assuming global economy is not doing very well, the US tank, the EU tank, then refer to what happened in 2008. The Federal Reserve would likely reduce interest rate and start QE4. What happened over there? Now, if the Federal Reserve starts QE4, US dollar is going to tank. Okay, US dollar will fall, and if US dollar fall, investors would be, will be moving back to resource-based industry, and that's when it will benefit Malaysia economy. Like during the period of 2009 to 2011, yeah, we see a spike up in a lot of the commodities, counters, and so on. So it's like whether it's down or whether it's up, okay, you will always have some opportunity. Okay, now if let's say you are buying a REIT right now that satisfy your level of risk, okay, sometimes people may say that yes, let's wait for a crisis to happen. Now, if a crisis doesn't happen, then how? Does it mean you want to wait until a crisis before it's happened? So that's why investment is not sometimes do call for patience, okay, but then it's also based on if you are if it meets certain criteria, okay, of your risk assessment, then you have that as a starting point. If let's say it goes up higher, then you can say that, okay, wow, this REIT actually has moved up in price. I don't think I want to continue buying up. Okay, so I may want to sell, or I would say that I wait for it to come further down, then I start to accumulate. Okay, so that's why as long as you enter at a certain level that meets your risk appetite, okay, then you know that, okay, you will not be you will not miss out on any opportunity, whether it's up, okay, or if let's say it's down, then you wait for opportunity to accumulate. Okay, so try not to. Sometimes we always expect that it is going to happen, but then it keeps on delaying. It's just like when Trump won the won the election, everyone says, if Trump wins, the whole market will collapse. Looks what happened. You see, a lot of people lost money as well. So that's why, first and foremost, whatever investment must meet your own safety and risk assessment. If you're able to meet that kind of level, then, you can start. But if you don't go chasing, after the momentum, when you realize that the higher it goes, the lower your yield, okay?
All right, so thank you, PC, for your excellent question and answer sessions. So I hope you all have all your questions answered, and I have basically cleared all the questions. Now, so today we are coming to the end of our webinar on REITs topic. So what about how can we propel forward in your investment journey? So we also have a series of webinars, like I said earlier in the beginning. So our next webinar is the topic of master financial statements. So in next segment, PC will dissect the financial statements with you to teach you how you can dissect the financial statements to the bone, how to read this indicator, how to read this ratio, and what does it mean to have this kind of ratio in great depth. So next Tuesday, April 4th, 2017, from 8:30 to 10 o'clock, and you may register from the link on the screen here. Now, some of you here would not remember the number because it's too long, so let me type in the chat box for you. So I've just sent out the next webinar registration link. If you want to register for next webinar, which will teach you how to dissect financial statements to the bone, please register through the link that I've just shared on the group chat. All right. So with that, thank you, PC, for your time, and thank you everybody for attending this webinar. And I hope you have a pleasant evening. Thank you.
Thank you, and thanks for tuning in. I hope you have a good session. Okay.
Yeah. Thank you, everybody.
Thank you.
Yeah.
Yeah. Bye bye.
Pleasant evening.